Do you want to make money in the stock market? If so, you need to understand cash flow. Cash flow is the lifeblood of any business, and it's the best metric for measuring investment value. In this video, I'll explain what cash flow is, why it's important, and how you can use it to make better investment decisions. So stay tuned, and let's get started. What is cash flow? Cash flow is the movement of money in and out of a business. It is a measure of how much cash a company has coming in and going out over a period of time. Cash flow is important because it is a direct measure of a company's ability to generate cash. Companies with strong cash flow are more likely to be able to pay their bills, invest in their business, and grow their earnings. Why is cash flow important? Cash flow is important because it is a direct measure of a company's ability to generate cash. Companies with strong cash flow are more likely to be able to pay their bills, invest in their business, grow their earnings, pay dividends to shareholders. Cash flow is also important because it can be used to measure a company's financial health. Companies with strong cash flow are less likely to go bankrupt. Investors can use cash flow to make better investment decisions. Companies with strong cash flow are more likely to be successful in the long run. How can cash flow be used to measure investment value? Cash flow can be used to measure investment value by comparing the cash flow of a company to its stock price. Companies with strong cash flow and a low stock price are considered to be undervalued. Investors can buy these companies at a discount and expect to see their stock price rise in the future. Here are some ways to use cash flow to measure investment value. Free cash flow yield. This is the ratio of free cash flow to the stock price. Companies with a high free cash flow yield are considered to be undervalued. Return on invested capital. This is the ratio of cash flow from operations to the amount of capital invested in the business. Companies with a high return on invested capital are considered to be efficient users of capital. Dividend yield. This is the ratio of dividends paid to shareholders to the stock price. Companies with a high dividend yield are considered to be good income investments. Investors can use cash flow to identify undervalued companies and to make better investment decisions. There are three main types of cash flow. Operating cash flow. This is the cash flow generated from a company's core business activities. It is the most important type of cash flow because it measures how much money a company is making from its operations. Investing cash flow. This is the cash flow generated from the purchase or sale of assets. It is less important than operating cash flow because it does not measure how much money a company is making from its core business activities. Financing cash flow. This is the cash flow generated from borrowing or repaying debt. It is the least important type of cash flow because it does not measure how much money a company is making from its core business activities. Investors should focus on operating cash flow when evaluating a company's financial health and investment value. Operating cash flow is the best measure of a company's ability to generate cash and its potential for future growth. Cash flow from operating activities is the most important type of cash flow. Cash flow from operating activities is the most important type of cash flow because it measures how much money a company is making from its core business activities. This is the money that a company has available to pay its expenses, invest in its business, and return to shareholders. Investors should focus on cash flow from operating activities when evaluating a company's financial health and investment value. Cash flow from operating activities is the best measure of a company's ability to generate cash and its potential for future growth. Here are some ways to analyze cash flow from operating activities. Trend analysis. This involves looking at how cash flow from operating activities has changed over time. A company with a positive trend in cash flow from operating activities is a good sign that the company is healthy and growing. Comparative analysis. This involves comparing cash flow from operating activities to other companies in the same industry. A company with a higher cash flow from operating activities than its competitors is a good sign that the company is more efficient and profitable. Ratio analysis. This involves using ratios to compare cash flow from operating activities to other financial metrics. For example, the free cash flow yield ratio compares cash flow from operating activities to the stock price. A high free cash flow yield is a good sign that the company is undervalued. By analyzing cash flow from operating activities, investors can get a better understanding of a company's financial health and investment value. Changes in cash flow can be a sign of problems. A company's cash flow can change for a variety of reasons, including changes in sales, expenses, or investments. However, if a company's cash flow changes significantly, it could be a sign of problems. Here are some red flags to watch for. A decline in cash flow from operating activities. This could be a sign that the company is losing money or that its expenses are growing faster than its sales. A decline in free cash flow. This could be a sign that the company is not generating enough cash to cover its expenses and investments. A negative cash flow from investing activities. This could be a sign that the company is investing more money in its business than it is generating from its operations. A negative cash flow from financing activities. This could be a sign that the company is borrowing more money than it is repaying. If you see any of these red flags, it is important to do further research to determine if there is a problem. If there is a problem, you may want to consider selling your shares or taking other action to protect your investment. Cash flow can be used to make better investment decisions. Investors can use cash flow to make better investment decisions by identifying undervalued companies. Companies with strong cash flow and a low stock price are considered to be undervalued. Investors can buy these companies at a discount and expect to see their stock price rise in the future. Assessing a company's financial health. Cash flow is a good indicator of a company's financial health. Companies with strong cash flow are more likely to be able to pay their debts, invest in their business, and return cash to shareholders. Managing risk. Cash flow can be used to manage risk. Companies with strong cash flow are less likely to experience financial problems. By understanding cash flow, investors can make better investment decisions and improve their chances of success. Cash flow is a key metric for business success. Cash flow is a key metric for business success because it measures how much money a company has available to pay its expenses, invest in its business, and return to shareholders. A company with strong cash flow is more likely to be successful in the long run. There are a few things that companies can do to improve their cash flow. Increase sales. This is the most obvious way to increase cash flow. Companies can increase sales by offering new products or services, expanding into new markets, or increasing prices. Reduce expenses. Companies can also improve their cash flow by reducing expenses. This can be done by negotiating better deals with suppliers, cutting back on unnecessary spending, or laying off employees. Invest in assets. Companies can also improve their cash flow by investing in assets that will generate future income. This could include investing in new equipment, expanding into new markets, or acquiring other companies. Manage debt. Companies can also improve their cash flow by managing their debt. This could include paying down debt early, refinancing debt at a lower interest rate, or negotiating better terms with creditors. By taking these steps, companies can improve their cash flow and increase their chances of success. Cash flow is a valuable tool for managers. Cash flow is a valuable tool for managers because it can be used to make better decisions. Managers can use cash flow to make better decisions about how to allocate resources, invest in the business, and manage risk. Identify problems early. Managers can use cash flow to identify problems early, such as declining sales or rising expenses. This can help managers to take corrective action before the problems become serious. Plan for the future. Managers can use cash flow to plan for the future, such as making investments or expanding into new markets. By understanding cash flow, managers can make better decisions and improve the chances of success for their company. In conclusion, cash flow is an important tool for financial analysis, investment, and business success. By understanding cash flow, you can make better decisions about how to use your money and improve your financial health. Here are some other catchy conclusions that you can use. Cash flow is the lifeblood of any business. Without it, a company will eventually fail. By understanding cash flow, you can help your business thrive. Cash flow is like a river. It flows in and out of a company, and it's important to manage it carefully. By understanding cash flow, you can keep your business afloat. Cash flow is the key to success. Whether you're an investor, a manager, or a business owner, understanding cash flow is essential. By understanding cash flow, you can make better decisions and improve your chances of success. Thanks for watching this video. If you enjoyed it, be sure to hit that like button and subscribe to our channel for more great content. And don't forget to check out our other videos, where we cover a variety of topics to help you grow and achieve your goals. We appreciate your support and look forward to helping you on your journey towards success. Thanks again for watching, and we'll see you in the next video.